Welcome to Mark Arnold's Finance. Today I'm going to compare two controversial stocks. Both these stocks get a lot of hate out there, and I thought it would be fun to compare them. Those two stocks are AT&T and Altria. So before we get started, if you're new to my channel, be sure to subscribe. I'm very transparent, and to start off with transparency, let's look at how my portfolio is doing. As we can see, I am back in the red. This is something I was expecting. I was in the green for just a little bit, but we're back down. Amazon was in the green a little bit. It's back down to about 6%. I was expecting that. Of course, Meta is, I think, going to show some pain for quite some time, but eventually I think this will be heavily in the green. And one of the stocks that we're going to talk about in this video today down there, AT&T, is down 10% for me. So yes, back in the red, and I expected this. In fact, as a long-term investor, as you all know, I'm okay with being in the red. That means I just get to add more to my companies that I feel are undervalued and of high quality. So let's get started with this video, and let's start with AT&T. Now this really needs no introduction, but it's a telecommunications company. And if we look at its stock chart, you know, over the last 5 years, if you've invested in AT&T, you're down almost 28%. This has not been a nice stock for investors. In fact, it gets a lot of hate as people really focus in on how this stock just keeps going down, 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 and never seems to see an end in sight with that. You know, there's been a lot of predictions about a turnaround, but so far we really haven't seen it. With AT&T, one of the big things with them is their debt. You know, they tend to hold massive debt. So if we look here, you know, this is comparing back to 2017 now to 2021. The long-term debt is still remaining near all-time highs, though it did go down slightly from 2020 to 2021 from almost 76 billion to 174 billion. And as we know, they're refocusing their efforts on bringing down that debt. So hopefully this is just the start, and we will start seeing some huge decreases in its debt. That would be awesome. Now let's look at its PE history. The thing with its PE ratio that you have to know is it did spin off Warner Bros., which did kind of alter the history of its PE ratio. So right now I'm just going to show you the current PE at 8.77, which is kind of in line with the telecommunication services average. And what I could find with its history, taking out that kind of blip with what it spun off, it's kind of been the same. It's kind of held steady at this kind of low PE ratio, which means to me it's really not in value territory if it hasn't really dipped. So there's its PE history and ratio. Now let's look at its financials, which I think is super important to look at any company's financials. So their debt to assets is 67.7%. This is high, but it's not horrible. And the reason being is AT&T is a cash cow machine, which really helps offset that high debt. But it is still too high for my liking. I'd like to see this below 50%. The profit margin is healthy. It's at a 53.92%. Anything above 50% to me is acceptable in my book. So this just you know, makes that mark. Let's look at their revenue. Now, if we look at the trailing 12 months revenue, you'll see that it has gone down almost 6%. It's at 5.72%, where the telecommunications average across the services sector is down 1.33%, so it is trailing that. And its revenue growth over the last 5 years is relatively flat at 0.62%, and it does trail the average for the industry as well. So revenue is a dog. It's not great, and so yeah, that's just something to keep in mind here. If we look at its cash, the almighty AT&T cash, we will see that in 2017 it was near 50.5 billion. It went down massively due to some acquisitions, but it is trended up this year in 2021 from 2020 and sits now at over 21 billion, which is a great sign for AT&T to start building that cash back up, because it is wanting to focus on reducing that high debt. Now let's look at the juicy dividend, or is it juicy? Right now, it sits at a 5.34% dividend yield and has a payout ratio of 47%. Now, let me say that they did cut their dividend, and by almost 50%. And to me, I've always expressed this, but that's acceptable to me because they were again at levels that were unhealthy and not sustainable. And in order to focus that on reducing their debt, they had to cut somewhere, and they decided to cut the dividend in almost half. But I think long term, that's going to be a great thing if they can get that debt down. That's going to mean growth for this stock. I really do believe that. So just keep that in mind with what we look at. So 5.34% dividend yield, 47% payout ratio. Of course, that downtrend on the growth chart to the very right is when they cut their dividend, so it kind of is misleading. If we look at its dividend growth history, of course, you'll see that dividend got cut in virtually half from 52 cents per share to 27.7 cents per share. And it shows that growth of negative 43.63. So again, in context, you have to realize that they did cut their dividend. So this is really not the best representation, but that it is what it is. So I just wanted to show this chart. And if we move on, I want to talk about AT&T's market share. Recently, they've actually made some progress. They're the middle part in gray, where the bottom in blue is Verizon, which has been shrinking, where AT&T has been increasing. And this is wireless subscriptions market share by carrier in the US. So just keep that in mind. If you look at the top, the yellow and the green did combine into one bar. That's because T-Mobile and Sprint, they combined together as one company. So you kind of have three major players now. You have T-Mobile, you have Verizon, and AT&T. So I like to see this kind of trend here in the US of AT&T kind of growing their market share, and more so than the others, which is great. If we then move to a fundamental analysis of what analysts think, we are going to see here that AT&T is only slightly considered undervalued. It is more towards the high range of quality, but its growth stability is low, and that is absolutely correct. This company is a slow growing company. It's almost like a utility company, so I definitely agree with that rating. Its financial health is actually towards the healthy end, and I think that's because of all the changes they recently made. With management's focus on reducing that debt, I think that's just a gold kind of standard to look at it and be like, they are focusing on the right things. So just my opinion, of course. If we look at analysts' score, kind of looking at bearish versus bullish thesis, we will see here that AT&T is rated at a 4.7 out of 10, so kind of neutral. You might have some buys in there and some holds. I don't know if there's any sell ratings, but it's right in the middle. So I would say they're pretty much saying it's just a hold right now, not really a buy. And if we kind of end AT&T, I will say, end with AT&T, shall I say, I will say that, they did cut their dividend, which really I think made their payout ratio to a very respectful, safe level now. And I like this. They're going to focus on paying down debt, and they had to do something with that debt. And hopefully what this will do, not in the short term, but long term, will create a company that is able to start growing again. And you'll see that stock chart, instead of going down, 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 hopefully will start to recover in the next couple years and start to be an okay investment for investors. So there's going to be slow growth with this company, being being that it's saturated in the market and in the telecommunications sector. Like I said, it acts like a utility company. It's just going to be a slow growth company. I don't think we will see a downtrend. I think this company will just hold that slow growth, but still find ways to increase their revenue and profits year over year going forward. And they have the potential with the 5G growth. So what I will say with AT&T is, when this stock gets to a level where the dividend payout ratio is above 6%, that's when I would start buying if you're looking and interested in this company. I'm going to give my final review of what I'm going to do at the very end after we review Altria. But if you're looking at buying into this company, I would say make sure that dividend yield is a 6% or above to give you some level of safety with this stock. So that's AT&T. Now let's switch over to Altria, another kind of hated stock. Of course, this is a tobacco company. And if we look at its chart, its 5-year chart, we will see that it's not it's actually worse than AT&T. Over the last 5 years, it's been down 42%. So it has not been a great investment. And to be fully transparent, I did invest in this company for a short period of time in 2020, but luckily I was able to get out with a small gain. And that's because I bought in for the wrong reasons. I let someone else kind of dictate what I do. And I made a video recently that I said you always have to do your own research. So when I did that, I realized this wasn't the stock for me. So I got out, glad I did. But you'll see here has not been kind to investors. So what about Altria's debt? Well, if we look here, we'll see that their debt and current liabilities has kind of maintained the same level, but their long-term debt has gone up over the years. It kind of dipped down a little bit from 2020 to 2021. So I would say their debt is pretty high, especially compared to their cash, which we will look at in a minute. But let's look at their PE ratio and their history. We will see here that the trailing 12 months PE ratio currently is at a 26.34, where its 5-year average is at a 22.89. So it's actually trading at higher right now than its 5-year average and well above the tobacco industry average. You'll see there in that second column. So to me, that's a little pricey compared to what it has traded at in the past and also compared to its competitors. If we look at its financials, we will see it's kind of a double-edged sword here. Their debt to assets is not good. It's at 104.4%, pretty darn high. So that gives you an indication that the debt, versus the cash is not good. Also, their profit margin though is exceptionally good. We saw with AT&T it was in the 50% range. This one is at 70.72%. So that is actually really good and kind of a shining spotlight of this company. What about their revenue? Well, if we look at their revenue, we will see that Altria in the trailing 12 months has only grown about 1.81%, where the average for the tobacco industry is 8%. And the last 5 years, it's only grown 1.77%, where the average for everyone else is 7.26%. So their revenue story is not that great. And their earnings per share, especially the bottom two, that trailing 12 months and the last 5 years, has been deeply negative. And only when you compare this last quarter to the same quarter prior year has it shined at going up over 40%. But its earnings per share has not been overall a good thing for this company. If we look at Altria's cash, we will see that it does increase overall, but it has had a slight reduction in 2021 from almost $5 billion in 2020 to now $4.5 billion in 2021. So I don't like to see that downtrend, but let's see, of course, due to the economy and everything, what this company will do in the next couple years. So now let's look at the dividend, which is where this company really shines, but kind of doesn't, and I'll explain why. So they are at a huge 8.34% dividend yield, but their payout ratio is 220%. That is not good. Their growth is above the market median, just slightly. So what I will say, just looking at this, is I think this means they might be at risk for a dividend cut. They might, go down the same fate as AT&T. No one can, for sure say, but that's just a prediction that I put forth, my opinion. Not saying that that's a guarantee, but just a prediction. If we look at their dividend growth, so what it's done in the past, we will see here that it's 1 year growth there at the bottom. They've grown their dividend 4.65%. So it's actually a decent percentage due to how high their payout ratio is. And you will see here that green line is their stock price. So it has dipped where the dividend is maintaining and growing. So maybe it's a time to buy in. I don't know. I'll give you my opinion here at the end. If we look at Altria's fundamentals, they are considered overvalued. I definitely agree with this. Their quality is high. Their growth stability is towards the high end with a 69 out of 100, and their financial health is at a 61, which is less than AT&T's. AT&T's was, I think, like a 79, if I remember from just a few minutes ago. And I think the quality, what that means for this company is they do have that huge profit margin, but they are overvalued. I do agree with that. We looked at their, PE ratio versus the sector and versus their trailing 5 years, and it's just pretty high right now. Let's look at what the analysts score this company. Now they actually score a little higher than AT&T, but it still falls in the neutral range. It's at a 5.9 out of 10. So I think you probably have some buys, but mostly holds with this company. I tried to find market share data. It was kind of dizzying. I found so much varying information. What I will say is overall, globally, Philip Morris has the share. In the US, it looks like Altria has a huge market share, if not, the biggest. So, let's talk about a few things. They did invest in Juul, the smokeless tobacco company, and that is possibly going to be banned in the US, which could be bad and good. That, obviously being banned by something they invested in is not good, right? They're going to lose money on that investment. But this can mean now that Juul doesn't have that huge market share in the US, Altria can possibly go and create their own smokeless products under their own brand name. So that's something that they could do. Now, I looked at their R&D spend and it's actually gone down. So I don't think that's anything they'll do, pretty quick. But, let's see what happens in the next couple quarters, what they report with their R&D. If that starts going up, then we'll know what they're doing. They also have a stake in Anheuser-Busch, which hasn't been good for them. So that's another dog on this company. So what I would say is I do think the dividend is at risk of being cut like AT&T due to that high payout ratio. Their product, the tobacco industry as a whole, is a downtrending product. I've looked at some charts, and each year the people that utilize tobacco gets less and less. But they can charge, that high premium for their product because people get addicted, so that's just what it is. Also, you got to keep in mind the market, the economy, the view of people is moving more and more towards, pro-environmental, regulation and looking at how companies have a positive impact on the environment, where this company, being a tobacco company, is not going to have that, nice view from the public. So that's kind of a negative as well. So let's look at my comparison that I have, and let's see how we did. So with the PE ratio, AT&T takes it here. They're at a much better value than Altria. With the revenue for the trailing 12 months, Altria takes it, even though it's just a 1.8% growth. It's better than AT&T's negative almost 6%. Now their last 5 years revenue growth, Altria still takes it at 1.77% versus AT&T's almost flat 0.62%. The dividend yield. So this is kind of, not the full story, but AT&T's yield is 5.34%, where Altria's is an 8.34%. But I'll just put up my opinion with my risk, saying that Altria could cut this. It's just, there's nothing out there to say they will. It's just something that could happen, so just keep that in mind. Now, the one-year dividend growth, of course, this is going to look weird because AT&T cut their dividend almost half. You'll see here with negative 46.63%. While Altria has raised theirs over the last year 4.65%. Now the dividend payout ratio, AT&T is now under that 50% payout ratio, which I like, so it's 47%, but Altria is not looking good, and that's where I think they're at risk because it's at 220%. The debt to assets, now 67.7% goes to AT&T, and they're the winner because Altria is above 100% at 104.4%. So again, not good, and why I think that dividend could be at risk. Now the profit margins, this is where Altria shines. They came in at 70.72%, where AT&T was only 53.92%. If we factor in the analysis score, they give Altria just a slightly better rating at a 5.9 out of 10 versus AT&T's 4.7 out of 10. And what I did is I put in this future score. This is my personal opinion on these companies' future. I did rate AT&T higher at a 5 because I think it is more like a utility company, and I do think it'll at least grow just at a slow rate. Where Altria, I think there's a risk where their revenue can decline. They have a downtrending product, and their PE ratio is high, so I do think we can see some stress on this company's future over the next couple years especially. So what I will say is, even though Altria has more green with the analysis I did, so it kind of takes it there, there was some caveats, right? AT&T cut their dividends, so if Altria does the same, they can kind of be in the same boat, and we don't know how much Altria would cut theirs if they did. So I would say that's kind of makes things complicated. So I'm going to give the win to AT&T just because I do think this company is focusing where it should finally, and that's reducing their debt. And yeah, it came at the cost of cutting their dividend, but that's what I would want to see as a stock owner of AT&T, because that just means management is doing, even though it's a tough decision, they have to do what they need to hopefully spur some growth in the future. And I'd rather have that than a declining stock price with a slow growth dividend. So that's what I'd rather have. I'd rather have that growth in the stock chart with a healthy dividends, and that's what AT&T is doing. So I give it to them. Where Altria, I think their dividends at risk. I think they're a downtrending product. Obviously, they're having a little bit of a mix-up now with Juul, their smokeless tobacco product. So we'll see what happens there and see if they act on it and create their own product. So let me know what you think. If you think AT&T or Altria, which one is, if you had to pick one. Now, mind you, I wouldn't invest in either. I got into AT&T early on when I started investing for the wrong reason. I will state that. But if I had to pick one, I'd pick AT&T. But which one would you pick? Did I get anything wrong? Did I miss anything? Let me know, because these are two stocks that I feel are pretty hated. So I'd like to hear your opinions and what you thought of this comparison. And with that said, we'll see you next time on Mark Arnold's Finance.